Weekly Global Economic Analysis. When markets stop reacting to the news. Setting the analytical tone. This week, if you followed the global economy, you probably noticed something familiar. GDP figures were released. Inflation data came out. Central banks spoke. Global forums discussed the future. And yet, market reactions were surprisingly muted. In macroeconomic analysis, this is not a sign of calm. It is a signal. Because markets only stop reacting when they believe that new information does not change the bigger picture. In this video, I won't go through each headline one by one. Instead, we'll look at the entire economic week as a whole to understand what the market is paying attention to and what it is quietly ignoring. China. GDP without shock, but shifting expectations. Let's start with China. The latest GDP data was released this week. The number was not weak. It did not signal an imminent slowdown. But market reactions were limited. That tells us something important. China is no longer being viewed as a short-term driver capable of changing the global economic trajectory. In the past, Chinese data often reshaped expectations for commodities, supply chains, and global growth. Today, Chinese GDP is increasingly interpreted as a domestic signal rather than a global catalyst. China remains large. China remains important. But it is no longer a source of surprise. And when an economy stops surprising markets, capital stops reacting, even when the data is not bad. UK CPI and ECB, from inflation to time. Next, inflation data from the UK and communications from the ECB. A couple of years ago, these releases would have driven volatility. This week, they didn't. That tells us the inflation narrative has shifted. Inflation has not disappeared, but it has been fully absorbed into market pricing. The key question is no longer, how high is inflation? It has become, how long will current policy conditions remain in place? This is a critical transition in the economic cycle. When markets focus on duration rather than magnitude, it usually means the peak of tightening is already behind us. Emerging markets and capital flows. Early signs of expansion. Indonesia's interest rate decision did not dominate headlines. But in the broader context, it matters. During periods of stress, capital tends to concentrate in a few perceived safe centers. When uncertainty fades, capital slowly begins to expand its risk perimeter. The renewed attention on emerging markets suggests the market believes the largest shocks of the cycle are behind us. This is not aggressive risk-taking yet. It is early positioning, testing the environment. WEF and IEA, long-term themes, lower urgency. The World Economic Forum and the latest IEA report did not introduce new short-term information, but they reinforced long-term narratives, supply chain restructuring, energy security, structural growth shifts. What stood out was the tone. There is no longer a sense of urgency. These topics are now treated as processes, not crises. And when markets view challenges as processes, capital allocation becomes slower, more selective, and more strategic. The United States, a stabilizing anchor. The United States did not deliver new policy signals this week, and that, in itself, is the signal. The U.S. is currently perceived less as a growth engine and more as a stability anchor. Capital is not leaving the U.S., but it is no longer concentrating there exclusively. The global system is slowly shifting from a single center structure to a more multipolar configuration. What this week really tells us. When we step back and look at the week as a whole, one theme becomes clear. Markets are not searching for new narratives. They are confirming existing beliefs. This is not a week for aggressive action. It is a week for understanding what the market now considers the new normal. Looking ahead. What markets will be sensitive to next week before we close? Let's look briefly at the week ahead. This is not a forecast of prices going up or down. It is about identifying where market sensitivity is increasing. First, real economic growth data. After a week of confirmation, markets will pay closer attention to indicators that can challenge the current equilibrium. Production, consumption, and employment data will matter more than inflation prints. If growth shows clear signs of slowing, reactions could be stronger than usual. Second, policy language, not policy decisions. Markets are not expecting a shift in central bank direction, but they are extremely sensitive to subtle changes in tone, especially around how long current conditions may persist. Small wording changes can drive meaningful expectation adjustments. Third, market reactions themselves. Next week, the most important signal won't be whether news is good or bad. It will be how markets respond. If negative news fails to push markets lower, it suggests underlying support. If neutral news triggers sharp moves, it signals fragile positioning. Conclusion: next week is unlikely to deliver shocks. Instead, it will test the resilience of current expectations. And how markets pass that test will tell us far more than any single headline.